Hey guys, so back-to-back interest rate rises, 0.15, 0.25. What's it mean for property investors? So the Bank of England has decided to raise interest rates by 0.25. And I think really everyone knew it was going to happen. There was no surprises in the market. So I think actually that's what was expected, okay? And I think throughout 2022, we're going to see slow but incremental increases just to bring that inflation back down and to mop up the spare cash in the that's sloshing around in the economy. Because let's face it, we've printed 40% more currency into existence during coronavirus. So that's got to go somewhere. It's gone into assets, it's gone into property, it's gone into things like that. So, and actually the good thing about it this time too is it's gone into people's pockets. So they've actually gone out and spent it, which is great. Or actually they didn't go out and spend it, which means they've got it to spend. So they've either paid back debt. So actually it's been a pretty good thing. And let's face it, we've had over 10 years now where interest rates have been very, very low. So them going up isn't necessarily a bad thing. It's expected, it's all part of the cycle. So I think if you haven't had any, you've been investing in the last 10 years, you've only just started, and this is the first time it's happened, this is normal. Let me just explain big background. So basically, monetary policy, fiscal policy. Monetary policy is raising a lot of interest rates. Raise interest rates means people pay more interest, so therefore they have to, more money's coming out of the economy and going back to the Bank of England effectively. Then lowering means there's more being put in, there's more available to be spent, which stimulates. So they raise interest rates to slow down the economy and to aim for that 2% target of inflation, okay? We're well above that right now. Look, who do you believe? The government figures I always find are on the low side, not the high side. And so therefore, real inflation that you're feeling in your wallet might be a bit different. But irrespective, it's a constant measure, which is good. The other side is monetary policy, which is taxes and things like that, and how do the government earn income. So they're the two things that that most of the time they play with. But how does it affect property investors? Well, quite simply, what you have to do, because we're now into a phase of raising interest rates, okay? And that's likely to continue, who knows, for the next year, 2 years, okay? Depending, hopefully, and what they'll probably do is raise them slowly, okay? Because if they raise them too fast, too quickly, that could shock the market. Everyone stops investing, everyone stops spending, and then we go into this drop. Now, if we have inflation that's going up and economic activity going down, that's a pretty bad situation. It's something we call stagflation, not something we want to get into, okay? Because it's very hard to stimulate the economy in that perspective, okay? So slow and measured is likely to be the order of the day, all right? How much? Well, I think there's two aspects. How much are interest rates likely to raise? I'm just saying 1%. I'm saying from where they were, 1%. So probably, we'll get to around about 1.5, I think, at the end of this. So whatever your margin is on top of that, so 1.5 might be base of England, or the Bank of England base, plus what's your bank's margin on top of that, okay? That then will be your pay rate. So you need to work out your mortgages based on that. Or, okay, you need to go, well, actually, what is the worst case, or the realistic worst case? And in that case, what I would say is probably work it out on 2% overall, so about 1.6 more. We've had 0.4, 1.6 more. And I think if you work on that 2%, then you should be there or thereabouts right through this cycle of interest rate rises before we start to stabilise, and then potentially they'll come down as we want to stimulate the market again. So that's sort of where I'm predicting they'll go over the course of this year and potentially next, okay? Now, anything can happen. Like most things in economics, it's really, if you ask, 4 economists for, answers, you'll get 5 different opinions, and most of them will be wrong. All right, there'll be the lucky one that gets it right, but most of them will be wrong. So, take it with a grain of salt, but redo your mortgages. And what I suggest is 1.6 more on whatever you're paying right now after this increase. Add that 1.6 on. Can you afford it? If you can't, then you need to look at your options, whether you sell, whether you remortgage to a lower rate, whether you fix earlier. There's lots of options. But the options you have, you're better to take them early than to leave them till the last minute and potentially not have that option anymore. So if you want some advice, if you want some help and, you know, sorting out your numbers and that sort of stuff, then by all means call the team and we can run the numbers for you, you know, with you, and basically get you certainty so you can sleep at night, which is the main thing. And that's the main reason for that 1.6 edition that we're talking about. All right, guys, have a great day. Live with passion. Any questions, you know, make sure you like, subscribe, and we'll see you soon. Bye.